Good morning, everyone. Welcome to Financial Bootcamp for Small Business Owners, Series 1 by Ms. Lorna Whitaker. Today is the third session of the series, and we'll talk about financial statements. How exciting. My name is Jeannie Yang, and I'm a business and loan counselor at PACE. Thank you all for joining us today. This webinar is brought to you in partnership with the City of LA Economic and Workforce Development, EWDD, and BusinessSource Pico-Union Westlake region, operated by PACE Business Development Center. This webinar will be recorded, and at the end of the webinar, you'll be asked to participate on our survey. So please make sure that you complete the survey, as it'll help us plan our future webinars in better ways. And before we learn something new today, I'll do a quick introduction on PACE. Trying to move to the next page. There we go. All right. PACE stands for Pacific Asian Consortium in Employment, and we were established in 1976, and we are a 501c nonprofit organization. From business and workforce development to utility bill assistance and housing and education, our 5 departments are equipped with necessary services to tackle poverty and economic inequity in diverse communities across the LA since 1976. Okay, so PACE offers one-on-one business counseling, credit and asset building, business and financial plan development, webinars, and training to help you establish a new business or to help your existing business. We can also guide you to get into the procurement contracting through our MBDA department. The greatest fact is that all our services are free. So if you have any questions about our services, programs, or lending products, please visit our website, pacelabdc.org, for more information. All right, let's dive into our topic of the day. Pleasure to have you back with us, Lorna. Please take on.
Thank you. Okay, so let me get my PowerPoint set up, and step 1. And share. All right, well, good morning, everyone. You can put your questions in the chat or just try to hang on to them till the end. I don't actually look at the chat that much during my presentation, but Jeannie can help me if something comes up that's real important, but we can always answer your questions towards the end. So today's presentation is, part 3 of the Financial Bootcamp series for small business owners. And we cover the financial fundamentals that small business owners need to know in order to create a business that delivers on its promise of financial freedom. Ultimately, that's what you're looking for. We start looking towards financial stability, and then we move into financial freedom. So the first thing that I have to do is I have to do my disclaimer. So I'm a small business consultant, a coach, and a financial skills trainer. The thing is I've been working for small businesses for the entirety of my career, and that's going to be about 4 to 5 decades of helping business owners build those financial infrastructures and operational infrastructures for their businesses. I'm not an attorney, a CPA, or licensed tax professional, and cannot and do not give legal or tax advice. I provide general information. And the thing about taxes and legal advice is that those conversations come up as an ordinary part of a business. If you have a question that's regarding a legal matter, go see a professional, go see an attorney. If you have questions about taxes, the best place to go is to a tax professional or a CPA. So what I provide is the information that you need in order to have and make money and run a profitable, well-run, easy-to-run business. So here's the good news. None of us was born knowing this stuff. It's all stuff that we need to know. And All of it is learned. Today, we're going to cover something that a lot of people really, really struggle with. We're going to talk about how to review your financial statements, what they are, the terminology, what they track, how to read them, and how to use the reports to analyze financial health and for strategic planning and best practices. Why do you want to know what's going on in your financial statements? Well, it's the only way that you can build and run a profitable business. You have to be paying attention to your money, and you need to know what those reports have to say. So earlier, last time, we did a basic, the fundamentals, the ABCs of accounting and bookkeeping. And we're going to cover those just briefly this morning in case you weren't able to attend that one so that you really understand the language that I speak. So, financial language for businesses is a language. So what is bookkeeping? Bookkeeping tracks the transactional detail of the business. And it's got to be accurate for it to be useful. So you need to know that the information that's being recorded and how it's being recorded is accurate. Okay. Accounting, which is kind of that part we're covering today, is that big picture view, the CFO part, Chief Financial Officer. Whether you're a sole proprietor, an LLC, a corporation, you are and will always be the CFO for your business. If you don't have those skills, if you're not confident with your skills, get more training because it is ultimately you that is making those decisions about your financial future. So your transactions will show you what's really happening, where your money is coming from and where it's going to, so that you can make informed decisions and then decide what actions you need to take. The key here is garbage in gives garbage out. So this is why your bookkeeping must be accurate. So let's talk a little bit about what you're going to see on the chart of accounts. It's broken down into two major categories. The balance sheet. This is everything that has happened in your business from day one. Okay? It tracks everything and it gives you a report that's very, very useful for you. It is probably the report that is the least understood by small business owners. A lot of sole proprietors don't even bother with it. I discourage you from doing that. Please learn how to use a balance sheet no matter where you are in your business, whether you're a startup, you've been doing business for a few years, or you're a very advanced business. Your balance sheet has lots of very important, useful information for you. The profit and loss report is that report that shows you your income, your expenses, and your net profit, okay, or net losses. Again, this is a very important report, and it is probably the one that is best understood by most business owners. So what's on the balance sheet? The balance sheet includes the assets, okay, what you own, liabilities, what you owe to others, and equity, the difference between the two. So, for example, if you buy a home and you pay $500,000 and you put in $100,000, you owe $400,000. So the house is worth 500 less what you owe, the 400, and the equity is the 100. Now, where that money came from can come from different places, and we'll talk a little bit more about that, but you'll learn more in the previous presentation on the ABCs of accounting and bookkeeping, and that is a recorded training that you can get from the PACE library. So what's on the profit and loss report? The profit and loss report includes your income. This one's pretty easy. It's the money that you make from the services or goods that you sell. And that's pretty much all it is. Costs of goods sold. So some businesses have costs of goods sold, some businesses do not. This is typically your inventory or some services that you may have to pay for out of pocket, and we'll do a little bit more on that. The thing is almost all of you in today's world will have one type of costs of goods, the merchant service fees. I really like to see those listed as a cost of goods sold because it helps you to track them. And anybody that has accepted a debit card or a credit card knows what those fees are. And I like to see them in this cost of goods because you can actually start calculating the percentages and see maybe you need to change your prices to include that amount. And then we have our expenses. So anything that is an ordinary cost of doing business, okay, is an expense to your business. And these expenses are different than cost of goods because you have them whether you make money or not. So a little bit more detail. Assets, something belonging to you. It's your cash on hand, it's your inventory, it's your furniture and equipment, it's vehicles, anything that you own, okay, is an asset to your company. Now, the IRS basically says that if you buy something, like let's say a computer, this is really common, you buy a computer, you don't get to expense that. It's not a deduction to your profit on your profit and loss because it's going to last longer than 1 year. However, there is no monetary fixed number of what that needs to be. So I laugh because I have a stapler that is probably 15 years old. I paid $15 for it. I put that on as an office expense when I first purchased it. That's not the kind of thing the IRS is looking for. They're looking for those bigger ticket items. But let's say that your computer needs to be replaced annually. Well, then it could be an expense. So this is something that you will talk to your tax professional about, where that line in the sand is for you, what really constitutes an asset for you. But generally speaking, it's a large ticket item, costs a lot of money, and it lasts longer than 1 year. Liabilities. This is something that you owe. You may have a debt that you have to pay off. You may have a loan. I encourage you to record your bills, your invoices that come in that you have to pay, put them on your accounts payable when you receive them. A lot of small businesses don't, okay? They put them on the desk or in a folder and they pay them as they go. But I really encourage you that using the accounts payable feature in accounting software is very useful for you in managing cash flow and in predicting for growth. So start taking care of that piece of your business. And so your credit cards are also something that is a liability that you owe. Okay. The difference between the two of what you own and what you owe is the equity. Real straightforward. So assets, liabilities, equity, this is the language of the balance sheet. And it's very important that you learn these 3 words and what they mean. So here's what a chart of accounts looks like. And hopefully I have my other slide, but we'll see. So the chart of accounts is what this looks like when it's prepared. Okay. You have your assets, liabilities on one side, and you have your revenue, costs of goods, and expenses on the other side. Okay. So financial statements. The profit and loss in report terminology is this. Income, it's what you get paid for what you do. Costs of goods, direct costs for getting paid. So we're going to look at some reports and you're going to see some other distinctions here of what costs of goods are. So it could be inventory that you bought that you have to deduct the cost of. Okay. It can be your merchant service fees. It can be direct contract labor. It can be employee labor. The IRS is not particular about what you put in here. However, it's a useful tool for you. One of the things that a lot of business owners think is that the financial reports and bookkeeping is for the IRS. It's not. It's for you. It's for you to run your business. Now, the next line here is gross profit, gross income, gross revenue. Okay. There's lots of different words that mean exactly the same thing. So your gross revenue is your total income that you have coming in. Okay. But your gross income is the difference between your income and your cost of goods. And you'll see that it's plus is income coming in, less cost of goods equals gross profit or gross income or gross revenue. Okay. Not net. That's later on. And then you subtract the expenses, okay, what it costs you to run your business, whether you make money or not, and that equals the net profit or net income. This number is taxable. It's taxable whether you're a sole proprietor, and it's at a different rate for sole proprietors, okay? And it is also taxable for LLCs, partnerships, and corporations. But it's all treated differently depending on the legal structure of your business. And this is where you'll get more help from your tax professional because those differences. So tax planning is partly your job, okay, and understanding these rules and such, but it is where your tax professional will step in and give you the help you need. So let's look at a profit and loss report. Okay. Now I've organized it in two columns for you. So you have the sole proprietor and you have the corporation. On the corporate side, we do have LLCs that are taxed as a corporation. And so you start your LLC and you decide whether you're going to be a single member LLC, which means you'll be taxed as a sole proprietor. You'll be a partnership, which means you will be taxed as a partnership, which is basically dividing up the net income between the partners, or you'll be taxed as a corporation. Typically, it's going to be an S corporation, which means that you can actually have a payroll and be paid through the payroll and pay some of your taxes through an officer's salary. We're going to look at how that impacts your business. Now, if you'll look at this report, you'll see that in the sole proprietor side and on the corporate side, the gross profit is exactly the same. There is no difference here with regards to your income and your costs of goods. All right. And if you'll remember from the previous presentation that we can have as much information about the sources of our income and the costs of our goods. This information is for you to decide how much you need with information you need. Okay. So if you want more information, great. If you need less information, also great. Not a problem. But as a business owner, the more information that you have, the better your decision making options are. So decide how much information you want, but don't make it so cumbersome or clunky that it's really hard for you to read or hard for your bookkeeper or you to track the transactional information. And you'll see under the job expenses, we have job materials. We have some subcontractors. Those are the total job expenses. If you're a business that sells an inventory, your inventory would show up here. The amount of the inventory that shows up under cost of goods is what you paid for it. All right. The income tracks what you got paid for it, but cost of goods shows what you came out of your pocket for it. So see, there's no real difference between the corporation, an LLC taxed as a corporation, or a sole proprietorship. Here's where all the differences begin. All right. Now you'll see that we have under expenses, we have the automobile and bank service charges. If you're putting your merchant service fees under bank service charges, which is kind of what they are, you're not going to be able to sort them out or separate them easily, which is why I like to see them under cost of goods sold. Your cost of your insurance, your payroll expenses. I like to see payroll all organized with everything that's related to payroll, which would include the workers' comp, the gross wages, the payroll taxes. So under here, ordinarily, you would also have your officer's salary included under payroll expenses. It will be a separate line. If you'll look kind of to the bottom here, you'll see where it says officers' salaries, officers' payroll taxes. And I did that specifically so that I could show you how it impacts your tax liability and your profitability, which is something that a lot of business owners who were sole proprietors, become corporations, get very confused and concerned about. So if you'll note that the net ordinary income and the total expenses are exactly the same for the sole proprietor and the corporation when we pull out the officer's salary and the officer's payroll taxes. So I just pulled them down under net ordinary income so that you could see them. Now, under a sole proprietor, all right, you as a sole proprietor, you take your money out through an owner's draw, okay? You do not take it out through a salary, all right? As a sole proprietor, you cannot be on the payroll. Your payroll is for your other employees. If you're a corporation or an LLC taxed as a corporation, you can get an officer's salary. In fact, you pretty much have to. You have to take an officer's salary, and your tax professional will help you decide how much that needs to be. So why would we want to do that? Well, if you'll note that under the sole proprietorship, okay, your taxable amount is going to be the $54,000. Of that amount, you're going to pay, all right, 15% minimum for self-employment tax. So you need to plan about 20% of this $54,000 to be paid for out in taxes. This is very problematic for business owners that are struggling with cash flow to set that money aside. So this really, you really want to be looking at your profit and loss report to know what your taxable burden is going to look like. I would like to remind you and point out that if you're not being taxed, it's because you're not making any money. So let's really start not worrying about what we're going to pay for taxes, but plan for it instead. Now, for a corporation, you will see that the officer's salary reduces the net income down from 54,000 to 3,000. All right, so this is all that would be put on to your tax return. It's called a pass-through. It passes over to your tax return. So on your tax return, you would have a W-2 that would show the $47,000, okay? And then you would also get another $3,000. This particular report does not include depreciation for your assets. That's something that your CPA will help you do once a year. So technically, if your depreciation is $3,000, only $400 would pass over as taxable income. And you can see that there's a huge difference because why? Because the company is picking up the cost of your Social Security and Medicare, which is what the self-employment tax is that a sole proprietor pays. Now, I know that for some of you, this is a lot of information all at one time. The thing is that you can start learning this information and you can go, oh, I remember hearing that there's a difference between how I'm taxed as a corporation and how I'm taxed as a sole proprietor. And the better I understand this, the better I can do my tax planning. The taxes that you would need to pay for income tax on the corporate side has already been paid and reported as part of your salary. This is usually very helpful for business owners because they're paying a little bit as they go and there's less tax planning involved. But there's also a savings of 7%, which is about the cost of the Social Security and Medicare that the company is paying for. As a sole proprietor, your self-employment tax, you pay all of it. You pay all of it. And people have asked me regularly, well, when do I know when to become a corporation? Well, that's a legal conversation. However, on the tax side, what we find is that when your net income is pushing $70,000 is where you should be having that conversation with your tax professional. All right, and then get set up for a corporation. If you anticipate that you will be making $100,000 net, well, then get out in front of it. Go do that at the first of the year. That's why tax planning and projections and such are so useful for the business owner. So, what is it about the balance sheet that we need to know? Well, again, assets, it's what you own, liabilities, what you owe, and owner's equity, the difference between the assets and the liabilities. So here's the report. What is it that I need to know? Well, you can see under assets, I have my cash, okay, and I have my accounts receivable. This is an important number, okay? The accounts receivable represents money that is owed to you. It only happens with businesses that send out invoices. So a retail company that gets, sells the goods and they get the money right then and there, they don't really have an accounts receivable. Business owners who provide services almost always have some kind of accounts receivable. This is an asset for you. You want to make sure that when you're reading this report that you also get an aging report. That means who owes you, how much they owe you, and how long it has been that they have owed you this money. This is why the balance sheet is such a great report. You're going to spend just a few minutes looking at it and going, do I have receivables that I need to pay attention to? Well, if your receivables are only $3,000, that's actually a fairly low number. Okay, to get your aging report, do a quick check, see if there's anybody that needs to be called to get that money. But I've seen receivable reports that were over $300,000, and some of it was very old. The problem with old receivables is there's a real chance you will never get that money. And if you're uncomfortable making those phone calls to get paid, well, then you're not going to see that money. And that's your money. You've provided the goods and the services for it, and you are entitled to be paid for it. So don't let this one make you uncomfortable. Just do what it takes to get an aging report and follow up on it. You'll see that you have inventory. Well, okay, I've got $1,000 worth of inventory, but if I'm selling $3,000 worth of inventory a month, I probably don't have enough inventory on hand. And if it only takes a few days, well, that's not a big deal. But I've got a client, it takes 8 weeks to get the inventory. She has got to really be out in front of this number because she's selling $5,000, $6,000, $7,000 worth of inventory a month. And if she doesn't have the inventory, she doesn't have the income. So looking at your inventory number is really important. The equipment number, that's just what that asset is worth. You'll see some depreciation later on it, but that's not a big significant number. Paying attention to the cash you have on hand and your receivables, this is what's important here. What's important under the liability section? What's your accounts payable? Who do you owe and how much do you owe them? When is it due? How old is it? I'm going to tell you that if under accounts payable you have purchases for inventory that you have not yet paid, the people you buy your inventory from probably will not send you more inventory. So you want to be paying attention to your accounts payable. And here again, that you get an accounts payable aging report that tells you how much you owe, when it's due, and how old it is. Now, if you look at this particular report, you'll see that we do have cash on hand of about 50,000 and our accounts payable is only about 8, which means that I can pay that. I'm not going to have any particular problem paying that. But if my cash on hand is significantly less than what my payables are, chances are I'm going to have trouble keeping up with these. Payroll taxes due is one that shows up on your liabilities report. As the CFO for your company, right? You want to know that this number changes. You want to be sure that the payroll taxes are being paid in a timely way. The same thing is true for the note payable. You want to be sure that your payments are going out for these items. And you can get a cash flow report on it showing what was paid. So, but the big one for you is going to be what's due for accounts payable. And this one doesn't show credit cards, but credit cards are also seen under liabilities. I know that this stuff can feel very dry, can feel like they laughingly, stereo instructions in a teeny tiny font are really hard to understand. But I can guarantee you that if you do a little practice, you take this and you start walking through it step by step, like going, what does cash represent? What does accounts receivable represent? What are my accounts payable? Are my payroll taxes being paid? Is my sales tax being paid? Have I been making payments on my note payable for my equipment? Or if you have an idle loan from the SBA, are those payments being made? What are those things and are they being handled? One of the points I'm going to make here happens to do with the owner's add and the owner's draw. And we're going to see this number again on another report. All right. For the sole proprietor, their money comes to them by way of owner's draw. It is not seen on the profit and loss report. And it does not impact the net income. And the net income, remember, is your taxable amount. The other thing is that when you add money into your business and it comes out of your personal resources and funds, or even a loan from a parent or a brother, that money goes into your company as an owner's add, an owner's contribution. That is not income to your company. Okay, very important. And I stress this over and over because it is a common error that I see with business owners. Money that you put into your business that comes from you is not income. The money that comes out for you, that comes just straight out of your bank account, is a draw or a shareholder's distribution, depending on your legal structure. And these things do not impact the profitability of your company. They affect cash flow, but not profitability. So let's take a look at the cash flow. All right. So if you'll note that we have sales, okay, of $57,000, okay, and we have the owner's cash of $25,000 for a total cash in of $82,000. All right. You'll see for cash out, we have the things that we saw on the profit and loss report: advertising, insurance, and interest, okay? But we see an inventory purchase. Let's say we went out and bought $19,000 worth of inventory. All right, that's not on the profit and loss report. That is only cash out of your business, which is why you ended up probably having to put in the $25,000, because you didn't have the cash available to pay for that inventory purchase. You'll see that the note payment is on there, and again, the owner's draw for $5,000. How the cash flow is different, okay, is that we have the accrual basis accounting and we have cash basis accounting. Accrual basis captures all of the invoices, all of your payables, everything that is due, all right? And credit cards are handled a little differently. When you purchase something on a credit card, that expense goes immediately to wherever it went. Let's say that they were all just regular, ordinary business expenses. And then that liability is created. That liability for your credit card is not included in your accounts payable stuff. It's a separate line item. So the thing is that you owe that money, all right, and you might have to make that payment, but you've already that stuff has already been what they call expensed out. So the credit card purchases are treated a little differently than on a cash flow or an accrual basis, cash basis, accrual basis accounting. The thing is that when you make a sale and you have an invoice, if you remember that in our accounts receivable, we had $3,000. And even though under accrual basis, we showed that we made $60,000, we didn't actually receive that full amount. We only received in cash $57,000. So when you look at your reports, you want to look at your profit and loss report based on both an accrual-based report and a cash-based report. And I know that for some business owners that switching back and forth between those reports can get confusing. So they're usually printed right on the report, and you just pause a moment and go, am I looking at cash basis or accrual basis? Do I understand the distinction between the two? And basically, under cash basis, you're going to see only the money that you have received and only the money that you have paid out, except for credit cards. Under accrual basis, you're going to see everything you owe, everything that's on the accounts payable, everything that is owed to you, so the money you've received and your accounts receivable. Again, I know that this stuff is a lot of information all at once. It's just so that you can kind of get started on this. The best way to do it is to grab your own profit and loss report and your own balance sheet and start looking at them and make sure you start understanding the language. And if you don't, get more help. And there are people out there that will help you. So people like me, there's people at Pace, your CPA, there are people, even your bookkeeper can give you some guidance on this stuff. But ultimately, you're responsible for knowing it. Remember that you put in the $25,000 out of your own pocket and $5,000 came out of your business for yourself. Okay? All right, let's talk about some best practices. If you have an in-house or third-party bookkeeper, be sure that you receive your reports timely based on your needs, okay? Don't accept a lot of excuses for why they can't deliver them to you. Make sure that they're reasonable. You can receive reports that aren't fully reconciled. I worked for an attorney for years who he wanted his reports on the 1st, but his bank statements didn't come in until the 15th. In today's world, the banks have aligned the sending out of their statements. They typically come out after the very end of the month. Okay, they're dated the last day of the month because this was a problem for business owners not having timely bank statements and credit card statements. The credit cards can still typically kind of be different days, but you want to be sure that you're receiving reconciled reports and that everything is up to date and properly recorded. Again, you want to be sure that you're just kind of checking in with in-house and third-party bookkeepers to make sure that you're looking at your bank statements and your accounting software for compliance. Look at that every few months, every quarter. Just pop in and make sure that everything is being done. I did recently have a client who just found out that his bookkeeper had not been reconciling the statements. Okay, he was very upset. He thought that they were reconciled. She had told him they were reconciled, but it wasn't until he went into the accounting software that he discovered they were not actually being reconciled. Hope you know what that term means. There's a term. Reconciled means you're comparing everything that's in your accounting software with your bank statements and credit card statements to make sure that everything matches up, that you don't have duplications or you don't have things that are missing. Because if you have duplicated income, you're going to pay taxes on that. If you have missing expenses, well, guess what? You're going to pay taxes on that because you didn't deduct it. So you want to be sure that you're in full compliance every few months. My recommendation is put getting your reports on your calendar so that you can review them no less than monthly. All right. You can look at cash flow statements more frequently if you need to, but your regular financial reports, you should be looking at them monthly, and you should just carve out that time, 20 minutes. Once you get proficient at this, and I mean just even barely proficient, it'll only take you 20 minutes to look at these two reports. You as the business owner know more about your business than you give yourself credit for. I have found this over and over for business owners. They really do know what these numbers are. If you don't know what the numbers are, find out. That can take longer, but you need to know what those transactions are. So, block out time at least once a month to analyze your financial health. Your profit and loss report, 6 to 18 months by month, accrual and cash basis. Most software will put them into monthly columns. This allows you to see the changes in your income and in your expenses. This is important because if you see a big change in something, it's something you're going to want to find out why there was a change. Had a client that saw that all of a sudden he was paying a lot of money for car insurance. It had almost doubled. And so we were able to reduce that by going after that and getting a different quote. But he wouldn't have noticed that unless he had seen it on the report. Okay, he'd noticed that things were getting harder, but his bookkeeper had just paid it. He'd turned it in. He hadn't looked at it very closely. So look at the profit and loss report by at least in 6-month window. 18 months is really great for a little deeper dive if you'd like to do that. Look at your balance sheet. I prefer it run in accrual basis. I noticed that some of the reporting services are now pulling it up in a cash basis. For some companies, it doesn't make much of a difference, and other companies, it makes a big difference. So look at your balance sheet from an accrual basis. However, maybe once a year, have a detailed report printed that is cash basis. So you can make sure that your inventory is being paid for, that your sales tax is being paid for, that your payroll taxes are being paid for, that sort of thing. Those deeper dives can be done 2 times a year, but definitely, look at it periodically. Get an accounts receivable aging report. Follow up on it with anybody that needs to have a collection activity on them. Make a couple of phone calls. Accounts payable, here again, you want to be sure that nothing gets too old or that you know maybe why it's not been paid. Maybe you have a dispute going on. Maybe that's a reminder to follow up with them. Okay. And then get your tax liabilities aging report. My very best advice on this is sales tax, pay them when they're due, pay them every time, figure out what you're going to do. On your payroll taxes, I really encourage you to use third-party software or a very proficient, well-trained payroll person, bookkeeper who does and understands payroll. Pay your taxes as you go. Pay them with every payroll. For many businesses, cash flow can be and is very challenging, and tax liabilities have got to be paid. And then block out some time for some strategic planning at least once a year. Every quarter is great, by the way. It does take a little bit of time. However, it's really important for you to know, is my business growing? It's good to know that your business should be growing about a minimum of 10% per year. 10% per year. They can easily grow 15% to 25%. Numbers bigger than that are more challenging, but completely doable. The thing is that it takes planning and looking at what your expenses are and how much cash flow you have and what you can really tolerate for growth. And the only way to do that is to pull out a profit and loss report for 18 to 24 months and look at that, okay? And really start to understand what's happening with your money. When you do this and you feel uncertain or really confronted by it, it means that you need some more training. Set up an appointment with someone that can help you navigate this. It takes practice to do this. What are you looking for? Well, you're looking to see what income and expenses do you have now? Where can you grow your income? This is why having additional line items on your profit and loss report about where your income is coming from is so helpful, because you can say, oh, this part of my business is doing well. This part of my business is doing great. Let me put a little more attention behind that part of my business. So how will you grow your income? Do you need to hire employees? Do you need more marketing? What is actually going to happen there? This takes a little planning, okay? And we have more workshops coming up later on in 2025 that we can start talking about this. So, stay tuned, basically. So what additional expenses you need, and can you reduce costs, maybe even your officer's salary for a short period of time? Maybe you can take less money out of your business for you to pay for the extra marketing or the extra employee, because employees should start bringing in more money for you. Marketing should start bringing in more money for you. And marketing in today's, electronic social media world, that can bring results in 3 months. 3 months. It used to take longer, 6 to 9 months. Today, you can turn stuff around very, very quickly. This stuff is like learning to ride a bike. At first, you're going to need training wheels. You're going to need somebody to give you some help. But when you get the training that you need, you're going to go from being stressed and overwhelmed and financially struggling to, more confident, more focused. You're going to have the savvy that you need to make good decisions. So spend the time learning these financial reports. And I don't care if you don't like doing it. I care if you know how. So you want to know how to do this so that you can build a successful business, so that you have the money that you need for today and tomorrow. And I promise you, one day you will look back and you will go, I know how to do this. Not sure how I got here, okay, but I do know how to do this. When you know how to do it, it takes less time. You have more time to do what you want to do. And it really makes everything that you need to have for making and having money possible. So I want to let you know that coming in January, we are going to have a very fundamental QuickBooks training available for you. So I think they're both in the same week, so that they're the beginning basics and some fundamentals for you. And I do have a free gift here for you. The traditional perspective about building a business has missed that business systems and structures and skills are not enough. So I have a little ebook for you to help you achieve financial freedom, and it'll be in a link in the PDF if you'd like to grab one for yourself. And then I am ready to start answering questions. And I saw a few chats there. So let's see what we have. Let me get up here and open up the chat bar.
All right. So we had a question with Christopher. Is there any tax advantage in any way of owning a sole proprietorship business?
So is he in the chat or where is he at? So
Christopher, let's try to find him.
So he has a construction company. Is it Christopher with the construction company? Mantis?
So.
Love the name. is there any tax advantage of owning a sole proprietorship business? No. No, not really. Not really.
That's
There
true.
are liability issues, okay? There are and no specific tax benefits. The thing is that the challenge with corporations and LLCs is that you have to have a separate tax return, okay? And so you have compliance and you have forms and you have $800 that you will pay to the state whether you make any money or not, and you can still end up paying more. So this is a really great question, Christopher. The tax advantage only becomes a tax advantage when we're seeing people making that in that net range of about $70,000, because it can cost $2,000 for the separate tax return. And then you have another $800 on top of that if you're in California to the state of California. There's $2,800. As you may recall in my example, the savings was only about $3,000. So there's that line where you kind of go, when is it best for me? For a corporation, if you have liability considerations, become incorporated immediately, okay? If you want to protect your name, become incorporated or an LLC immediately. The tax advantage through and having the ability to pay yourself through payroll doesn't occur until you're hitting that, 70,000 mark. If you're hitting at 54,000, as in my example, well, then maybe next year you should go ahead in the first part of the year and get incorporated and get those tax advantages that year. That's why, again, you want to be able to look at your profit and loss report to see where you're at from a cash basis, because you'll be reporting to the IRS under a cash basis. So you want to kind of look to see where you're at. But if you're going to make more than 70,000 the next year, start planning on it. Go ahead and get incorporated. So great question. Thank you for asking.
Okay, another question in the chat. Can you repeat the percentage of growth you expect a good sound business to achieve each year?
Oh, I'm happy to do that. So currently, inflation is at about 2.5%. Well, we need to exceed that. But if you're going to give your employees cost of living wages, if you're going to get the very best of employees, you're going to have to pay them very well. The thing is that all the things that you buy, all the expenses you have are not going up at 2.5%. They're probably going up at 5% or more. So the minimum that a business should plan on growing is 10%. You'd say, okay, I made X this year, then I need to multiply that by 1.1, which is an increase of 10%. I need to make this much money next year. Now, I will tell you that 15% to 25% is very, very doable for business owners. It takes a little planning and some strategies. The thing is that I have a client that struggles with raising his prices. And he went for years and years and years and years without raising his prices. And all he did was try to get more customers, which meant he had to hire more employees, which he had more expenses. So the net result was not that he was making more money, he was working harder. Plan on raising your prices once a year, okay? Stay competitive, but really know that you're selling something of value. So look at a minimum of 10%, plan for 15 or 20, 25, 15 or 25% growth. I had a client who she stopped taking her officer's salary, and she put all that money into marketing, and she grew her business by 40% in 1 year. And she only had to not pay herself for 3 months, which is why that was kind of in my example. It's completely doable. So really just, 10% is minimum, and why not go for it? Do a stretch or a target of 15% and a stretch for 25%. So thank you for letting me answer that question again, because I think it's very important. Business owners can and do have more power over their revenue and their net income than many of them realize. because it is about having a strategic business and using all of the tools and resources that you have. Do we have more questions?
All right, yeah, we have like a couple more. Let me finish up with the webinar chat. I've been asked to be on a board of a new 501c that is a sole proprietorship. They want me to write grants for them as well. Can I hold a title with the nonprofit as well?
Okay. Complicated question. First of all, I will guarantee you that they are not a sole proprietorship. The only thing that can be a 501c3 is a corporation. Ba-dum-bum. Okay, so you have some misinformation in there. If their goal is to be a 501c3 and they're still a sole proprietorship, they will have to file all their paperwork. They have to get it, become a corporation. They have to file all their paperwork and do all their compliance. Okay, executive officers for nonprofits can receive a payroll, that they can receive a payment. Okay, if you're actually on the board, then it's my understanding that that's a no, that you cannot be on the board. Now, there can be variances there. So again, this becomes a conversation for a tax professional of where that distinction is can you be on the board and an executive officer? I don't actually know the answer to that question. If you're just there to write grants for them, all right, then you can be paid as a grant writer and be on salary for that. So there are a lot of questions in there for you to find out and seek out a tax professional. And I will tell you, there's lots of good answers out there that you can Google, and you can look to see who the resources are, because there are a lot of CPAs and tax professionals that are looking to provide information so that they can get more customers. So there's good information out there, but you have a significant error in the first part of your question, because they cannot be a sole proprietorship. So great question.
Okay. Let's move on to Q&A section. There's a question from Alfredo. Can you please repeat where a partnership falls in this option? I think that's from your slide deck. So
right.
Yeah.
So a partnership, partnerships have to be organized in a particular way. They do need legal documents. Folks, a partnership is like a marriage. They're really easy to get into, and they can be really expensive, frustrating, and upsetting to get out of. You must have paperwork. Partnerships are typically set up as LLCs, because that's one of the functions that it can do, is it can be taxed as a partnership. So whether you have one partner or 3 partners or 5 partners, they can all be part of that partnership agreement. You'll have the LLC. And from a tax basis, your net income gets divided by the number of partners that there are in the company, and they each receive an amount in accordance with the partnership agreement. So that if it's just 2 partners and they are agreed that it's 50-50, then they each get what's called a K1 that shows what they income that they earned from the partnership. Here's the thing to know about that, okay? Even if you did not get paid any money at all from the partnership, you will still be taxed on the net income. Okay, I'll repeat that. Even if you received no money at all from the partnership, you will be taxed your pro rata, your percentage of the net income. And if there's another question you want to ask regarding that, just go ahead and do that. But that's really important. So it's typically an LLC setup, legal setup as a partnership.
All right, another question. Getting a corporation is complicated as far as I know. Is that right?
No, getting a corporation is not complicated. Getting an LLC is not complicated. Understanding the rules for compliance is just a set of rules. I mean, if anybody has ever played a board game, you know that there's a set of rules on how it gets played. The corporation is just that. It's a process, step by step by step. Once you've created the corporation, then you have to maintain the corporation or the LLC and be in compliance. So you basically file your paperwork with the state. Okay, you set up your bank account for the corporation. You have a separate set of books for that. You have books for that corporation. The thing is that the operational or financial pieces of a corporation require you have to have books. You have to. You have annual minutes. Okay, easy to do. Only take a few minutes. Okay, you have to stay up to date with your statement of information. You have to file a beneficial ownership information report with the federal government. All right. And for all of you here, if you have LLCs or corporations, all right, that is due January 1st if you have not yet filed it. And it's a one-time deal unless something changes. It's called a BOIR, Beneficial Ownership Information Report. It's easy to do. If you have questions, my email is here on this slide. I'm happy to answer your questions. I'm sure there's people over at PACE that understand what the BOIR is, but corporations are not hard to set up. They're actually very, very easy to set up. Just get into compliance, just step by step. Hope that makes you feel more comfortable. They're not. You just have to, it's just a process, and you'll learn the rules quickly. Okay.
All right, so it's past our time frame, so unfortunately we have to go. If you have more questions, here's Lorna's email. Make sure you email, or you can also email to me, jyang@pacela.org for more questions. Thank you everybody for joining us today, and wish you best holidays.
Absolutely.
Christmas is around the corner. Yay. And hope to see everybody in our QuickBooks webinars in January. Make sure you register for that. Yep. All right, that's it for today.